Ladies and gentlemen of the crypto space, we're live on a Friday, March 20th at 11:53 a.m. Today is a day for context. Oh, it's context that's before my time, but the things that I have experienced and learned over the past, let's say, decade of my adulthood have forced me to extrapolate backwards in order to fully digest, absorb, and assimilate that historical context to understand where we are and where things are heading and the way things may or may not head. So there's obviously uncertainty in the way things may head, but generally there is a directionality in play, independent of the variables. So directionality is so much more important than the variables. So I love zooming out. Most folks don't zoom out. So I zoom out obviously heavily on dollar charts, specifically the DXY, one of my favorite highest time frame inspection. But every once in a while, I'll look back on boomer meme coins. So this is a chart of boomer meme coins. Meme coins, just like what, Peanut or pick your favorite meme coin on Solana, dating back to 1959. So these are the meme coins that the boomers bought, the old people, the older people. I don't mean that necessarily overwhelmingly in a derogatory sense, but this is what they could play with from a meme coin perspective, because that is what they are, that is what they were, and that is what they will continue to be. These are created because a group of people get together and say, we have enough capital, we could go to a bank, we could get the underwriting required, and they could launch this meme coin on this market. Now, this is obviously a general index of meme coins, 500 meme coins. There's obviously like 20,000 or so of them on the various equity markets, but that's what they are. That's how they are created, and that is why people buy them. They buy them not because they're investing in companies, not because people invest like Warren Buffett and they're buying the stock because they're buying a part of a company. That's not why people, that's not what people did and what people still to this day do with their brokerage account. They buy something because they think it's going to be bought by other people. Well, they technically they buy something because they think it's going to go up in price, but things go up in price because it's being bought by other people. So if I buy something and then 1,000 people go out and buy the same instrument, the same stock ticker, it goes up in price. So what I bought was at a cheaper price than what they paid for it. They drove up the price. Now I have something that can be sold at a higher price point. That's the fundamental mechanics of something that is nothing. That is the mechanics of the psychology, the psychological mechanics of the trading process. Now, that inherently is going to be fragile. Why is that going to be fragile? It's completely dependent on psychology. It's dependent on emotions. It's dependent on greed. It's dependent on the mechanics of gambling. You get in and you got to get out before everyone else does. And that is really what drives things like this, these equity indices that are highly long term. Now, there's two takeaways from this chart that I like to inspect. One, it's up and to the right. You can look at the dot com boom. I'll get out a brush util. You can look at the dot com boom. It looks pretty much like it's nothing. Then you can look at 2008, which is sharp, but it pretty much looks like nothing compared to where we are. So this proves obviously first and foremost time in the market beats timing the market with regard to accumulation of assets, rule number one. And two, it also indicates a general tendency for what's required for economics and politics to actually continue to function. Now, this plays into something I talk about a lot with regard to political optics. Now, political optics basically requires a functional economy such that people have a capacity to be employed, and they are employed so they can pay their bills. And so you're not going into your neighbor's house with a shotgun to take their food. And that the political optics is so that the politician gets reelected. So you need a stable society, and that's achieved by the politicians making decisions. So they present things that have favorable political optics. They look good to the general public. The politicians are making decisions that the general public are like, oh, this is going to be good, so I'm going to act normal and civilized. From a current political standpoint, has anything changed? And this is a very high time frame inspection. Look at the political rhetoric. Look at, for instance, the history of some of the popular topics nowadays, voting, and the narratives from like Chuck Schumer, for instance, back in the 90s versus today. It's a completely the story is a complete 180. Why? Because the politicians only speak from what is a politically favorable perspective. The optics must always be favorable. They're catering to the general public. So, what does that mean? It means everything is going to be relatively stable. You're going to have periods of instability, but the politicians want to get reelected. So they're able to massage the both political and economic situation in order to get reelected. Not only reelected, maybe some newbie comes along and he wants to get elected. So everything out of politics is going to be focused completely around stability. And that's from a societal standpoint. Society must be stable. Otherwise, you get a rollover, a turnover in the political class. And that is not what anyone wants. They don't want to lose their job. They want to keep their job. So they will always say and do what is good from a political optics standpoint. So this brings us to what is real. 2000, which is highlighted in the left circle, the dot-com crash right here, and 2008 in the right circle. And then we come to like 2022, which is the crypto crash. And the crypto crash in 2022 is only comparable to the year 2000 in equity markets. That is the most important thing that I have observed over the last years. Why? Why is it only comparable to the dot com crash? Because prior to 2020, there was no market for cryptocurrencies. There was just cryptocurrencies. And you needed to experience 2016 and 2017 in order to have that context and a capacity to really appreciate and understand what it was like. It was just pure meme coins, but there was no market. There were only centralized exchanges. There was no DeFi. There was no financial system. So post 2020 is the world to inspect, is the crypto world to inspect that's comparable to what occurred in 2000 in US equities. In US equities, there was a boom, a tech boom, and it was dot-com companies. It was the boom of the internet. And unless you're in your 40s, you don't remember what the 80s and 90s were like necessarily. And it was a gold rush of people that thought they could come online with something new and creative. And mostly it was just a capital raise. And that's literally what 2017, 2016, and 2017 were like. in crypto markets. It was pretty much a capital raise type of process. That's what an ICO was, an initial coin offering. And the only thing that could be offered in 2016 and 2017 was, in many regards, what the securities regulators would focus in on nowadays is some sort of deal, a security offering. We're going to raise this capital and we're going to try and create an organization, a company that did something comparable to what they were trying to do in 1999. It was literally it was a capital raise. So 2016 and 2017 under the microscope, it was literally a period of capital raises called ICOs instead of IPOs. Now, post 2020, there was a lot of this capital raising also, but there was also this idea of emissions and tokenomics and monetary policy. And out of the sea of remnants of capital raises that occurred in 2016, 17 was something new. Something new happened in 20 post 2020 crypto world was the idea of a monetary policy at a protocol level which wasn't a capital raise in the traditional sense and really isn't a capital raise in almost any way you could frame it. Um, it's more akin to the economics of a nation state, a lot of these protocol monetary policies. I mean, think of first and foremost Aerodrome and Velodrome. Um, they did no capital raise. The protocol came online with a monetary policy. The emissions incentivize liquidity deposits, and the trading and transaction volume, the revenues there are distributed to owners of voter escrow depositors. So it's the bifurcation of economics that is new and novel. So that wasn't the first time we saw the bifurcation of capital flows with Velodrome and Aerodrome. That started obviously with the launch of Curve Finance and the origins of voter escrow. So in its rudimentary form, that's not deprecated to this day, it's just different and unevolved. I think there's an interesting conversation that the dromes have talked about heavily, discussing what they created. And it's not just the drones, it's what Curve Finance created with voter escrow, uh, that differentiated with a capital raise. So that's why the crypto landscape post 2020 is so important to really appreciate, because something new came about, something different. And that is what folks don't understand when they come to the crypto space, especially novices, especially young folks that don't have this historical experience with pre 2020 crypto, or even more so, the historical experience with old school equities and investing in the stock market of years past. They don't have this context to really understand how significant post 2020 was in these crypto markets and what emerged. So that brings us to 2022. So what occurred between 2020 and 2022 was a bubble. People think a bubble ends, bubble starts, bubble ends, but what is important isn't the start and the end of the bubble. It's the same thing as clearing out brush fire. It's the same thing as, well, that's the best analogy. What emerges post destruction, what emerges after the bubble, what comes from the bubble. And that is why post 22 is akin to 2002 in equity indices. So that is the most obvious comparison that I could think of and offer to everyone to best understand where we are in crypto markets. Now, obviously, well, it took 2002 to 2000, end of 2007, Q4 2007, for the financial crisis to really start. So this was, you could lump this all into an interesting conversation. I'd have to think about that. But look how long it took equity indices to get back to the highs, dollar denominated, non-inflation adjusted. It took 2013, took a solid 13 years. Now, it's a very different world we live in now. So the takeaway here isn't how long it took equity indices to recover dollar denominated. The takeaway is more structural, is more an observation of the product offering and what occurred. So 2000 was this large IPO craze from a tech perspective, all these capital raises. But what emerged from the ashes was the Amazon, was the Microsoft. I mean, we literally walk around, and Apple, we walk around nowadays thinking how big these stocks are. But back then in 2000, everything was absolutely decimated and destroyed. And by 2022, this stuff was uninvestable. Nobody could own any of this stuff. It was this it was such a comparable situation to what started in 2022 in crypto markets. A clean sweep, a fire burn, a brush fire of everything was cleared out. All the bullshit was cleared out. So what remains? So you got to understand, you guys survived between 2022 to 2026, and you get to experience what remains. That's your 2020, 2002 moment from a dot-com perspective. What remains after a structural change in not just technology, because obviously crypto is technology, because we crypto is going to fold into AI and micropayments and all of that conversation. You got to understand, crypto is so much larger than anything that occurred in 2000. It's so much bigger in scale and scope because you're not dealing with companies. You're not dealing with products and services that are tangible. You're not dealing with real estate, all the real estate that Amazon deals with, and Microsoft, and the office space, and the human resources. There's none of that. You're dealing with what I call companies that survive, that have no real estate, no human resources, zero debt. The token prices could go down and down and down, but the protocols are functional. They survived, and they will continue to survive because there's no failure scenario. The failure scenario in crypto is when the technology no longer works, when there's a malfunction in the protocol, when there's a hack, a security incident, and that's a loss of faith. Token price alone and depreciation alone is not why protocols failed between 2022 and 2026. It's all of those hacks and security incidences and breaches. That's what causes a failure. So all you've experienced between 2022 and 2026 is depreciation that is a psychological manifestation of the larger economic conversation, which is why over the last 4 years, we focused in much more so on the economic conversation than the technology, because a lot of the almost all of the technology we're still discussing in 2026 came out of 2020 to 2022. It's already been invented. It's already been built. It's already proven that it survived 2022. There's been very little to no significant advancements in the monetary policies and the protocol design at the fundamental level post 2022. And that's why the topic of conversation has been the five businesses of crypto, because that's all there is. So, what five businesses in crypto came out of 2020 to 2022 that still exist today? Why would they be more significant than anything that was created post 2022? I would argue they would be more significant because they have proven themselves with time in the market. People that invested in 2020 to 2022 retain those investments till to this day. So anything that came post 2022 just has less time in the market, has more need to prove themselves, and to top it all off, they're redundant. They do exactly the same thing as the technology that was created in 2020 to 2022. So there's nothing new. That's the biggest flaw in the psychology of new people trying to make it in crypto, invest in crypto, not not the headlines of meme coin traders that lost everything. That's just people playing the stupid old boomer meme coin game in the crypto landscape. We're talking about investors. So the investors that are coming in to crypto now, skewed towards younger generations, have a hard time distinguishing the reality that the old survivors are the actual better investment than the new things that do exactly the same thing. Because we don't need new that does the exactly the same thing. There's room in the market. I think this is a completely untapped market, and you can have a variety of things. I mean, look at Aave versus Morpho, or there's a slew of liquid, so on and so forth. Um, Slew of protocols that have the same business model of the five businesses with credit, which is just lending. But time in the market, I think, is the most important thing. The ones that survived 2022 have the best capacity, in my opinion, to outperform when these markets encounter favorable macroeconomic conditions. Okay, so that's what I wanted to start the conversation with today. I wanted to remind folks of the history of how we got to where we are and the things people experienced along the way, and the things that you really need to think about versus the things that social media tries to get you to think about, like price of Bitcoin is 69K. All right, let's give a little update on some shorter term perspectives, because we can. So over the last 7, over the last 2 months, going on 2 months, nothing has happened with Bitcoin. So you've experienced social media, all the headlines. I mean, not the war headlines, but certainly the congressional headlines, the Clarity Act, and everything coming out from a policy standpoint. Sure, we've experienced those, but aren't those constructive headlines? Aren't those the headlines we want to see? So those are good headlines. But out of all the bullshit that could be spewed by social media personalities, what has occurred over the last 2 months with regard to the price of Bitcoin? Literally nothing. Nothing. The last 2 months could have been zero commentary at all from any personality on social media, and nobody could tell the difference. The price of Bitcoin is literally the same thing it was in February. That's just what it is. It's literally, well, you see the red line. That's where it opened. That's where it closed. It opened up here. But look at this region. That's why I highlighted with the orange circle. It's basically gone nowhere. You got a range of 76,000 with the candle body closes at 65. That's a relatively trivial range in the grand scheme of things, because look at all this price action above it and look at all this price action below it. And all this financial activity has occurred within this simple orange circle. And then we have obviously the history of what happened the last time we were in a comparable situation from a more structural perspective, the moving averages. And I think it's different this time. It's not different in that we push below the 100 SMA, but it certainly is different that the high, the previous all time high back in November of 21, is not below the 200 SMA. So back when Bitcoin pushed below um, the high set in 2017, the price of Bitcoin needed to break below the weekly 200. But here, to get to the previous all time highs, Bitcoin does not need to break below the weekly 200. It is already there. So I think from a structural standpoint, we're in a very different world. And that's just from a technical standpoint, we're in a very different world. I mean, come on, we're in a very different world politically compared to back in 22. Just think about the administration's language, the Biden administration, and how hostile Gensler was. It was literally an adversarial environment. Attack, attack, attack. It's just that there was no value in crypto. Meanwhile, now we know that our congressional leaders see the, what they want to do with stable coins and the Treasury Department. Stablecoins offer the Treasury Department a capacity to manage their own currency without the Federal Reserve or, frankly, the Eurodollar markets. It gives Treasury Department a capacity to create their own dollar liabilities without affecting root money supply, without increasing M0. But this is why we always head into or always come back to the larger macroeconomic conversation. You need to know what the fuck M0 is and how Treasury prints currency. And you need to know how the Eurodollar banks print currency. And we need to know the composition of global currency to understand the relationship between the Federal Reserve and how significant it is. Every time you hear money printer go burr, it's such a bullshit meme that means almost nothing, especially when I tell you clear and straightforward that the vast majority of dollars weren't even printed in the United States. They were printed by foreign countries and foreign banks. I mean, digest that for a second. Come on, that's such a critical piece to the puzzle. And until you can digest that, can you really digest how Circle and Tether can provide a product to the United States Treasury Department that bypasses private banks, including the Federal Reserve? You need to understand how currency works. You need to understand how money prints currency. Until you understand that, you can't understand the scale and scope and the potential for these crypto products and services. So while everyone's focused in on these price points, these numbers, these ticker symbols that go up and down relentlessly, that seem like they go nowhere for months on end, the potential here is so much larger than 2002, so much larger than 2002 in equities. 2002 was a lifetime ago, was here. 2002 was the bottom in pretty much after .com. So as I started the stream, the bottom of .com was a result of capital raises of tech companies offering technological solutions, internet-based solutions. But now the bottom that started in 2022, that's still occurring 4 years later, so it's a long period of time, macroeconomics considered, is not that. Is not capital raises. It's products and services dealing with money and how money prints currency and how money prints currency plays into the way central banks work around the world, and they play into how fiscal authorities, treasury departments of actual governments around the world work. So rather than shipping and software and for Microsoft and Amazon and the like and hardware, we're dealing with the actual economics of the planet. which is the word infinitely larger, total addressable market, infinitely larger scale or scope. How could I put a word on how big the topic of conversation really is and really needs to be to understand the potential growth that can occur in this space over a short period of time? I think what's taken can be given back at 1,000% the rate, at 10x the rate. If they took 90%, you could get the 10x and the 100x 10 times faster. And I say things like that because of our short history. That's exactly what occurs here. What took 2018 to 2019 came back really quick. And then if you take all of this time between 2018 and the bottom in 2000 after 2020, the altcoin space exploded to a fresh high over an extreme short period of time, 558% between January between in 2021. In 1 year's time, 3 years of depreciation was wiped out. So, and that's not even putting into context where we are in these crypto markets compared to back then in 2020 and 2021. So that was the birth of these types of technologies, these financial products and services, these five businesses of the crypto space. Now we've established that these five businesses exist. We know who the oldest actors are, the resilient players, and we know that the government is behind them. They're a tailwind. They're reinforcing the success of these businesses because that comes back to political optics, tax requirements, receipts that are needed by the federal government in order to balance or at least pay for outstanding interest expense obligations as well as fiscal obligations, entitlement obligations. This is why we always come back to the larger macroeconomic picture. Okay. If you're on X or on YouTube, please feel welcome to ask any questions. More than happy to talk about anything on your mind. Anything else interesting that pops out to me from a technical perspective today? Others is marginally up. Let's go into the weekly and take a look at what I've been looking at, which is obviously the orange circle. This is our first cross of the 10 SMA, 50 SMA on the weekly others Bitcoin denominated since I would not consider this necessarily in October of 2023. I don't think we were nearly depreciated enough to call that a cross. I would say we're probably comparable to one of these earlier time frame crosses. Yeah, maybe a February. So this is why I would say we're probably more comparable to a February 2020, which is obviously the COVID crash. Obviously, COVID crash was different circumstances geopolitically, but from an economic standpoint, that was the earliest indicator of potential normalization. And then obviously it blew up into the end of 2020. If folks remember Q4, not really Q4, it's like November, December of 2020, was a highly depreciative time period. Most think of that as a very bullish time period. Nope, nope. That's when things started to fall apart at the end of 2020. And then 2021 came along, and then everything was off to the races. And there's your real cross of the 10 SMA and the 50 SMA when everything went absolutely parabolic. So don't look at these breaches, these price or candle body breaches of the moving averages. And that's not what's pertinent. What's pertinent is things like this. When you turn off the candles and you look at the MAs, here's the signal through the noise. So I would compare something like this. Let's do this. So here's your crosses. There's your crosses. So 10 SMA, 50 SMA is obviously going to be an early cross. So these are maybe our earliest of indicators suggesting normalization. You know what's nice here? This is what's nice. Horizontal line. Look at that. So that's a bit of a double bottom from a 10 SMA perspective. Uh, you could also do something like that. So not really a double bottom, but those are very interesting levels of potential normalization. That's a higher low. So higher low there and double bottom here and across from an MA perspective. You know what's nice about technicals and MAs? Everyone looks at them. So as much as they're just lines in a chart, they have a way of expressing this psychological reality that everyone must deal with because everyone is looking at the same data. So this is probably one of the more interesting charts to look at, especially on a day when Bitcoin is just absolutely horizontal, it's doing nothing exciting, but others is doing well. Others Bitcoin denominated, which means the businesses, the five businesses of these crypto markets. Yield basis continues to get hammered. Not really the most interesting conversation from a YB perspective. The hybrid pools is probably the most interesting thing on the horizon. Um, Other than that, aerodromes coming up. We're basically Q2. So we're talking what, 10 days for FCC? So we're talking about aerodrome mainnet launch sooner rather than later. So that's probably the other exciting thing on the immediate horizon. So obviously anything that comes out of yield basis like hybrid pools, you're excited from a curve perspective as well. So hopefully for some sort of price stability there, but price stability isn't the takeaway. What's pertinent is the conversation that I started this entire stream with. The price will easily get people thinking about the wrong things, thinking about total net worth, so on and so forth. You get a 10x in the portfolio and it happens in 2 months. And then by the time the crypto cycle is over, quote unquote cycle, and it's 100x on the money, no one gives a shit where things were at the bottom. They care where things are, not even at the top, because we discuss things much richer than buy the bottom, sell the top, but more of a structured portfolio management approach and cash flow. I don't give a shit where the top is. I care about what's going to continue to exist in the future, and I'm going to let the macroeconomic reality continue to be a shit show as long as things continue to exist. And they're going to continue to exist because of the reasons I started the stream with. Political optics require a completely managed financial system to continue to exist. Otherwise, you don't have social civility, and therefore you would have anarchy. And you don't bet on anarchy. You bet that the politicians will do what they need to do in order to maintain social civility, which means literally one thing and one thing only. Everything over enough time. Let's do this. That's a bad example. Over enough time, everything goes up and to the right. Arrow, good afternoon. Much a pleasure. Always a pleasure. Dow Jones, peace. How's your BTC performing in yield basis? What's been your APR? We could take a look. So some nice accumulations of VEYB. So that's cool. It's pure Bitcoin. You got 5,200 stacked up there. That's nice. Nothing to complain about there because that's one, it's pure Bitcoin. Two, it's going to continue to produce. I expect Bitcoin volatility to continue. Therefore, it's going to be just up and to the right. The amount of yield will continue to accumulate. Now, stablecoin yield, so autopilot going offline, that's an interesting one. Autopilot going offline from an aerodrome perspective means I'm back to probably operating aerodrome like Velodrome, and I've just accumulated unclaimed LP flows for the last months, which are not entirely stablecoin denominated. They're Bitcoin and Ethereum denominated, unclaimed, unrealized. So I'm going to probably operate Aerodrome much the same. I think I've accumulated enough capital for my financial obligations in 2026. So I'm not too worried about accumulating stablecoins at this point. Um, I'm more interested in accumulating non-stablecoin cash assets. Cash-like assets. Bitcoin's certainly a cash asset as I define it, and maybe Ethereum is I'll treat as a cash-like asset with regard to at least flows and not sell them unless they're at an opportune price point. Why sell your Bitcoin and Ethereum flows at these horrendously crash depreciated prices? Why not wait for more opportunistic times? Let's take a look at what the position is like. So obviously no revenues, but it's minus 8.73%. I remember seeing it at minus 15%, give or take. So minus 8%. Okay. I think it's in the green actually. That's cool. Yeah. No, it's not in the green. A little less than one. Put one in here. Okay. So it's going to do what it's going to do. Obviously, there's a lot of folks that say at some point there's going to be outflows. My two cents is people that put Bitcoin and Ethereum in here they don't care about the timing necessarily, or the look. There's even 3.5%, a little bit of volatility on Ethereum has produced some revenues. But I think especially the folks that put Bitcoin into these vaults don't really care too much about timing. They're like, all right, I have my Bitcoin. I have my Bitcoin. The protocol is working. All right, it might not be too much revenue, but in favorable times, that all of that negative balances out, and you're in the positive because it's going to produce the trading fees, and you're going to get your revenue. It's going to do what yield basis says it's going to do because that's the protocol, and the protocol works. So I don't expect those outflows. I don't expect the people that have deposited here to be the classical yield farmer that have an LP in Curve or Aerodrome, Velodrome, so on and so forth, or whatever that shoddy V33 on avalanches or black hole. Yield farmers. I don't expect these types of depositors to be those kinds of yield farmers. Maybe they're compounding into Bitcoin. I expect these folks to have a bit of a different mindset. My two cents. So APR is obviously zero for the time being until Bitcoin can figure out its direction, because that's where we are with Bitcoin, ladies and gentlemen. Bitcoin doesn't know what the hell it's going to do. It's trying to figure out whether it's going to break some significant structural MAs to the top or the bottom. It's got to figure out what it's going to do. I got no problem waiting. Gillis, good morning. Hope you're well. Aero fees on Aerodrome on mainnet will have to be a lot lower than on base, though. No, compare fees on Curve versus Aero or ETH swap as an example. Yeah, sure, but we could speculate all we want. We're gonna find out. It's coming, and I look forward to seeing what it does. I don't. I don't have many expectations other than the protocol performing like it has performed, and it will continue to perform. So I expect that cross-chain type of functionality. I expect so that autopilot implementation that they said they were going to offer in-house. Great, I expect that. Um, I expect buybacks like we have seen. The sunsetting of the flight school, and their more grandiose, it's incorporated buyback system or program, whatever they're defining it as. So that's my general expectation. I very much look forward to their launch. How to balance keeping a healthy cash position and DCAing subjectively undervalued assets. So, okay. So my two cents is this is all dependent on so many factors. One, we've been in these markets for years. So we've been DCAing and buying assets for years. So we're sitting on healthy supply of assets that we've built for years. I don't need any more assets. I know where my portfolio will be under more favorable economic conditions. And I have an expectation that under those favorable economic conditions, the portfolio will be multiples larger from a total net worth perspective than it was in previous favorable economic conditions, because any future favorable economic conditions will be structurally better from a political standpoint as well as a technology standpoint as well as an emerging market inspection of the crypto space standpoint. So I don't need more assets necessarily. So a big burden of capital management is focusing on net worth. Um, but a reality is it's not the most important inspection. And two, um, sometimes what matters is balancing the budget. Do you have enough cash to pay your bills? It's not about having more cash. You're trying to squeeze more cash flow out of a portfolio that's weak. It's not fragile because what has survived has survived. You made good choices, but it's weak because it's depreciated, it's deflated. So my expectation isn't to have the cash flow I had last year. I expect to have cash flow. There's going to be, I have pretty much a rough sense of what the cash flow will be for 2026, and it's going to be significantly lower than 2025. But there will be cash flow. Um, so my psychology and entire expectation for 2026 is, can I pay the bills? And if I can pay the bills, I have that set aside, and I have an expectation of how much extra cash I will have above and beyond the bills. All right, if there's an opportunity to acquire something, great, but I don't necessarily need to acquire more of pretty much anything. Um, I don't have any temptation at the moment to buy anything. Um, I did exit that small Ave exposure. I just see weakness there, uncertainty. Maybe it would have been better to roll it into the more speculative Velo to see what that conversion is like when they go, or maybe into Arrow, but whatever. It was just a relatively small clip, so I'm not really thinking about it too much. That I could have done something differently. I really don't dwell on decisions. I make a decision and I stand by my decision. I own my decisions. So I own that decision. And yield basis continues to slide now down below 12 cents. It is what it is. So you don't have to balance it. Don't your healthy cash position, never fuck up your cash position. You need enough cash to cover your bills, and that's the most important thing. If you have extra cash, now it's the same as a savings account. All right, never spend all the money you have in your savings account. If you have extra capital, you could think about spending it. You could think about obviously buying assets is a better way to spend capital than to consume, like on vacations and whatnot. All right, this is the type of year for folks that have a deflated crypto portfolio to not go on a vacation rather than go on a vacation. You never fuck up your cash position, whether the spending is on consumption and or investing. So this is a year that is relatively tighter than years past, and that's okay. The broken psychology is trying to keep up. Somehow, with a deflated crypto portfolio, we're going to be able to maintain the lifestyle we had during exorbitant crypto economic times. No, that's not real. That's okay. We have to humble ourselves sometimes, and you cut back until better economic times. That's my 2 cents. So, everything is, my man, everything is undervalued. This entire space is extraordinarily undervalued because of everything I mentioned at the beginning of the stream. The potential for this space is so enormous compared to Post.com in the equities landscape. It's hard to put words on how big the scale and the scope is. We're dealing with global money and global currency, as compared to what came post.com, which was enormous. But that was dealing with computers, which in hindsight was huge. Computers changed the world, but we're dealing with not the evolution of technology and the way business operates with computers. We're dealing with the evolution of money and currency, which is magnitudes, monumentally. It's in incomparable, light years larger. It's I don't have the word for it. The scale and the scope is just on a whole. It's not. It's apples and oranges of difference in magnitude, difference in potential. Time just needs to pass. What has deflated will reinflate. Cash flows will be what they once were, and magnitudes larger. I just literally the one when the Treasury Secretary of the United States, and we go from 300 billion to 3 trillion. Is that where it ends? Is that where global financials ends and all this whole story comes to an end and everything collapses into anarchy and chaos? I don't think 3 trillion is where it ends. I think that's a small drop in the global financial bucket because once companies find that they can either increase efficiency or create a business and create profits, I think it blows past that number by maybe an order of magnitude. You know, 300 billion, and it doesn't end at 3 trillion. It goes somewhere between 3 trillion and 30 trillion faster than anyone ever thought possible. And there's your bubble, ladies and gentlemen. There's your next bubble. Everyone thought it was going to stop at a 10x. Stable coins to 3 trillion. Oh, but it goes to 20, and then it crashes, and there's $10 trillion worth of capital destruction in the ultimate crypto bubble carnage where it crashes from 20 trillion to 10, but we're at 300 billion. So the bubble implodes, but what remains is this monumental new economic system, which is really the evolution of an emerging market into a market, because it's not really so as much as we call it this emerging market, it's just conceptually an emerging market. um, it's really this global market that is kind of part of all the existing emerging markets. It's this overarching market, a market of markets, of existing markets, yet a new market. So the potential for what this crypto space is quite unprecedented. We're still learning the verbiage and terminology that's going to be required to talk about it. So the best thing I could come up with was an emerging market, but it's not really an emerging market because it's already part of existing markets. It's kind of like the evolution or a chrysalis. It's the manifestation of existing markets. It's the convergence of global economies into this tapestry that's interconnected and interwoven. And the reality is it's dollar denominated. So much for that whole de-dollarization thing. Maybe from a money perspective and a Luke Groman reserves perspective, that's okay. I'm not too interested in reserves. The thing that interests me most from a dollar perspective is what is the denomination of interest payments at the end of the year. There's what, 300 plus trillion dollars, and interest is due in order to keep that in existence, and that people have to come up with dollars to pay that interest, corporations and governments alike. Um, and the chosen form of settlement. So if the interest payments are due in dollars, everyone owes them. The vast majority of settlement will still be in dollars. Whether everyone's storing dollars is another story. I think that's, look, who's running? Are any of us running around with a bank account with dollars? No, we're scrambling to figure out what assets to own. So that's our reserves. We're not even thinking in terms of dollar reserves. So that's what the conversation is. China's thinking in terms of gold reserves. So reserves are transitioning. That is going to be a very different future. What is the reserve currency? Who gives a shit what the reserve is? What I care about is the denomination of interest payments for global debt. That's much more interesting. President accounted for, sir. Yes, sir. Thoughts on gold? Gold is down to 4,500. That is a hell of a moving average breach from a weekly standpoint. Dare we look at the weekly? Look at that weekly, that 10 SMA in the weekly, 4,100. That would be one hell of a moving average regression. So I like gold. Gold was a good buy at $200 after the .com bust back in 2000, back in 2002 when after .com bust and everything started to recover, 268 bucks for an ounce of gold. So time in the market, gold was pretty good, except this damn period here was absolutely murderous. Look at that. From 2011 to 2000, it took 9 years for gold to break out of this cup and handle or whatever to breach a new high. So gold is a complicated one, but I don't think there's a genie back in the bottle type of moment. I think the composition of global economics is changing. I think gold is not necessarily an easy thing to purchase at these prices, all things considered, because it already broke out monumentally. I mean, this level took from 2020 to 2000, it took 3 years for it to breach this level, and it breached it quickly. 2 years from 2024 to current, so it's 2 years and a quarter. Um, and it ran from $2,000 to $5,000. So gold always easier to purchase in hindsight. Um, Always easier to purchase before a parabolic run. Now, bear in mind, you still got the parabolic run. I mean, look at that 10 SMA. You know, I wouldn't really inspect a parabolic run from a weekly standpoint. You want a higher time frame standpoint. So, from a monthly standpoint, you're still very much in a parabolic run. Get a mean regression to the 10 SMA and the monthly. All right, it's still pretty cool. That's not where you're going to make the big money. You're not going to get your 1,000x on the money in gold, but gold is money. Money. So that this is why I always talk about money versus currency and business. So money prints currency. Currency is a business. Currency has involves credit. So who issues credit? Private banking, as well as, frankly, one of the five businesses of crypto is credit. So that's where gold fits into the larger picture. Now, there's one other thing from a technical perspective I didn't bring up. It was the 10-year. This is one heck of a period of time. Um, there's a lot of uncertainty with the war right now, and you want to look at money. This is money. This is the global money. It's the money supply. It's the treasuries, because that's how the world prints currency using what we're looking at right now as money. Um, so this can that's a bullish engulfing if I've ever seen one on a monthly basis from 4% to 4.38%. And that was a bounce off the 50 SMA that's clear as day. I mean, that is one heck of a bounce. That's from an intraday perspective. So this is value loss in the global money supply. Um, this plays directly into Treasury decisions and conversations, how much they could issue, so on and so forth. And I know there's a lot of people that have opinions on this chart, but generally speaking, I think Treasury has done a great job since 2022, end of 2022. This is basically horizontal. Isn't that interesting? Look at that wick. That wick closed back in October of 2022 is literally 4.38%. It's literally right tick for tick where the interest rate was 4 plus years ago. Wild. So that means supply met demand. So Treasury has been able to balance supply and demand literally perfectly to the point where the relative interest rate, therefore the relative price point, is identical to what it was years ago. It's been completely flat. Is there any point in? There is no point in time in history where something like this occurred. This is the least volatile. Can you find anything? I mean, I don't want to go back to the 80s necessarily. No, there's some big spikes. I mean, maybe back here, maybe back in the 80s, the late 80s. But this is also a different world because this is where equities would sell off into global money. Equities would sell off into bonds, and you're able to have an 80-20 portfolio that did very well for 40 something years. So it's also a very different world because you have to inspect post this absolutely monumental collapse in interest rates back in 2020, which was only a few short years ago. This is such an interesting inspection post 2020. It's really post Q4 2019 when the United States banking system failed in September of 2019. Most folks don't talk about that. Called the repo crisis, when the United States banking system failed and they were bailed out by the federal government. They don't talk about that. They talk about March of 2020 like that was the event. It was September of 2019. That's the interesting one. That's when everything changed. That's when they had the standing repo facility, and now they have the standing reverse repo facility, and now they have the DTCC, which was Gensler's hallmark, Depository Trust and Clearing Corporation, where global treasuries are settled through a single choke point, which means the United States government has a control over the volatility of money in case of crisis. This wouldn't occur. That's literally what the DTCC resolves. He cannot have this. They'd close the market, and they so that would be an unprecedented thing if the DTCC started to throttle Treasury settlement. But that is basically what the governments have done. They have created these volatility suppression programs and these overage. Uh, that's what the repo and the reverse repo, they're able to manage overages. Uh, it's just excess in the market. These programs absorb the excess volatility. And that's literally what we've seen over the last 4 years. Look at these interest rates. It's completely horizontal. That is absolutely wild to look at how horizontal that is. Anyhow, Snoke, much a pleasure. How do you think precious metals will perform? I'm talking about the coming years, say up to 2030 and beyond. Well, I like gold. Gold's a great thing to own. Silver's probably a cool thing to own, preferably at the best price possible. But that's money. People don't make, you're not going to make, most people don't have much money. You have currency and you have assets. So you don't go to the supermarket with money. So people use the wrong terminology. When you go to the supermarket and you go on vacation or you pay your credit card, you're not paying with money. You're paying with currency. So money isn't really an investment. Money is something to store value. So it's not an investment. You don't make your money with money. Money, this is where you dump extra capital. Money is part of the cash position. So cash can consist of money and currency and object instruments with money-like properties, thus the Bitcoin and the stable coins, which have currency-like properties. So cash is spendable. There's no way to spend money in a supermarket. You can't bring gold into a supermarket and spend it. So you can't spend money. So it's important to be able to differentiate between what these instruments are and how people practically use them. Nobody uses money at all on this fucking planet to do anything. You use currency. And frankly, people aren't even using currency anymore. It's all credit cards, which is it's like a liability of a liability. They're not even transferring. They're not even transferring the liabilities. It's just Everything is changing. And that's why stablecoins are really an evolution of like credit card payments. It's a portable liability. The portable, fungible bank deposit. Because you don't really spend bank deposits. You have let's say you have $10 in a bank account and you buy something with a credit card, you have a liability with the credit card company, and you use the liability with the bank account, which is a bank deposit, and you transfer that liability to the credit card to pay off that liability, but you can't take that liability out of the bank. It's not like you can transfer. I mean, you can with like Zelle and there's some like Chase Pay, some relatively decent ways to transfer liabilities between people, but no way, shape, or form comparable to what you can do with a stable coin. I mean, you could literally transfer the liability from one person to on one side of the planet to another person on the other side of the planet. So it's a liability of a different nature and a different form. Stablecoins really change the global equation for the way how currency flows. Peter, I agree, Cap. Accumulating more cash like assets and assets that pay. Price seems undervalued. Here seems like better value to more my portfolio than stacking dollars. Yeah. I mean, unless you need the dollars. Yeah, so do you have, account for your car payments for the year, account for your mortgage payments for the year? Can you pay your bills? Can you pay for your children's school? Can you pay your taxes? I don't know. So property taxes and whatnot, which is due quarterly everywhere. So as long as you got your bills covered, everything else is probably not accumulating too much currency right now, which is what you're implying by the dollar symbol. Uh, that's why I said aerodrome and velodrome. I'm not stacking stable coins, part of the cash position. I'm retaining unclaimed, unrealized um, assets that are just getting accumulated. Uh, I really, I really, we have yet to hear how velodrome plays out, but when aerodrome goes to mainnet, I really hope I'm not forced to claim everything that's stacked up on velodrome. I hope that's not the case. I really don't want to manage that accounting because I don't want when I claim I convert to stable coins, and that's a good part of um, what I've coded into my business as a de minimis conversion. So there's a value of what you claim, and I state in the business structure that the value which I claim is basically the value of the stable coins I receive because I'm doing an immediate conversion, but it's probably a loss considering transaction fees and slippage. So I say the transaction fees and slippage, all right, great, I'm probably losing a couple bucks, but whatever. It's a de minimis conversion. If I claim $500 worth of Bitcoin, and I convert it to $490 worth of stablecoins, I'm claiming $490 worth of stablecoins, and that's more or less how I do my accounting, and and I factor in the loss into a de minimis rule. Whether there's a safe harbor for that is another story, but that's the structure which I bank on. Um, but I really do not wish to claim those unclaimed, unrealized velodrome lows unless I have to. I'd much prefer to wait for favorable market conditions. Morning Cap, staying sane, just joined. Thoughts on autopilot? Well, autopilot shutting down is fine. Is what it is. It was a side project by that crew. Worked very well. Um, Stablecoin yields, I claimed those and shut down my autopilot exposure, did my accounting, and I'm back to manual aerodrome management, which I will do as I do my velodrome management. Unclaimed, unrealized, volatile assets. Thoughts on this war cap? Does it need to end soon? Well, we're not in control over it. It doesn't need to do anything. It will do what it's going to do. Happy midterms are not necessarily. I don't have much thoughts. I think they will continue to create volatility in markets. I think the larger economic reality, it remains the case. At some point, global currency supply needs to expand, interest payments need to be made, tax receipts need to be received, and all the governments around the world, in my 2 cents, are focused heavily on the rules and regulations for crypto so that they can be taxed. So as favorable banking conditions come online from the Eurodollar banks and interest rates do whatever they're going to fucking do, at some point the Eurodollar banks issue favorable terms and the lending starts, global currency supply expands, and they have a way then to tax the growth of the most volatile assets on the planet, these crypto protocols. The big one was the 1099 DA, which came online this year. So I think the United States has its ducks in a row with regard to its capacity to tax the coming growth in the crypto markets, at least in the short term, and it'll get better for them over the next 3 years. So they'll be able to tax 26, and then 27 and 28, it just gets better as the 1099 DAs start to have cost basis from the centralized exchanges. Um, so I think the U.S. is prepared. I can't speak to other countries, but that's where I think everything is. Once the countries have the capacity to tax the growth in the crypto space, then they no longer have any reason to inhibit the growth of the crypto space. And in fact, that's exactly what we see. Every country has favorable legislation, even some of the shittier favorable legislation. It's still favorable because it folds it into the economic regime. If it's folded into the economic regime, there's no reason to inhibit its growth. And uninhibited crypto growth is going to be much more interesting the next time around as compared to 2020 and 2021. My 2 cents. Peter, getting better dealing with periods of austerity in the cash flow, total portfolio decline in dollars is not something that I worry about. Well, it's a concern from a capital management standpoint. Believe me, I am engaging with 2026 significantly different than I engaged in 2025. Conversations with friends and family and my wife are very different. We are able to do different things. We're able to do less things. We have less free capital available. But that is austerity versus prosperity. But the cyclical reality is prosperity follows austerity and vice versa. So a lot of my thoughts nowadays are focused on not just preparation, because I'm already prepared. I spent the last 4 years building what I needed to build to prepare for what's coming. A lot of my thoughts are on choices and decisions to be made during favorable economic conditions. What to do with excess capital? What is the cash position look like? What investments and diversifications are warranted? Um, I mean, you can only buy so much of the same shit. At some point, you don't need more exposure to something you already have, what's likely a large amount. And only you could define what a large amount is of a particular asset. So there has to be a limit. You're not going to be able to accumulate 10% of current finance. You're not going to probably be able to accumulate 1%. So, but that's okay. So there has to be a limit, and folks have to define their limits of what is a reasonable target for ownership. And then you diversify. You own different things. Maybe it's a rental property around the block. Maybe it's a small business idea, uh, a yogurt shop. Maybe my wife likes that idea. So these are the types of things that I think about nowadays. What to do in favorable economic times. What to do with excess capital. Um, what to do in a time of prosperity as compared to the prevailing time that we have, which is austerity, no doubt. Okay. Thank you all for joining me, ladies and gentlemen. I hope that was a useful, helpful conversation. It was about an hour and 40 minutes today. So it's a good one. If you need to rewind to the beginning to remind yourselves of why we have these discussions, that's the big picture story. It's the big picture that counts. It's not a period of austerity versus a period of prosperity. It's not a deflated portfolio versus an inflated portfolio. What deflates will reinflate, and what survives matters more than anything. Definitely compare the crypto space in 2022 to 2026 to maybe a little bit post dot com 2002-ish, because that is my 2 cents. That's the comparison that I started the stream with today, and I think that that makes the most sense to me, and I think it's a good story to tell and really try and understand. Friday, March 20th, 1:08 p.m. Thank you all for joining me today. 125 people made it to the end of the stream and are now all that much more rational because of it. Stay calm, cool, and collected over the weekend. Get some sun, sit in a sauna, take care of your health and well being. Be strong for your family. When your kids come to you, be strong. Be a strong daddy, and that to me, those are some of the most important things to think about as well, in addition to financials. I wish you all a good one. See you guys and gals next week. Till then, peace.